Upstart stock has been trending in popularity recently, and many people are wondering if they should buy more, sell what they have, or stand on the side and wait for a better timing. As the market is still very volatile at the moment, we should always be mindful about which stocks to pick and the exposure and the timing of our positions. Over the past few days, the price action of UPST or Upstart has brought the stock to around $87.50 before stabilizing around $79.59. As we look at the recent price action development of Upstart, the stock remains under a lot of selling pressure, as the market continues to be relatively unfavorable to growth stocks and risky investments in general. The stock has shown a little bit of signals that it wants to bounce back from the bottom and reverse its tendencies from the bearish trend it has been having for a number of months, and we have to yet to see whether those efforts will succeed. From a longer time frame though, I think that Upstart is currently sitting on a very critical price level from a historical perspective, and that should pique our interest, because over the course of its existence, Upstart has actually been on a bullish trend, and the recent downward pressure simply reduced the rate at which the price was increasing. Of course, we're no longer near the peak level of $400 anymore, but I believe that the shareholders have a baseline in their mind, and when they see the long-term price trends, they will also think twice before keep unloading. The downside now seems much more limited compared to how things were just a few months ago. From a long-term perspective, the stock is very slowly increasing, with a huge spike around 2020 and 2021 before dwindling back once again. This is a sign that overall, the market does have a certain amount of faith in the stock that allows it to slowly increase over time, and that at the same time the trend of the stock is very much affected by the overall market performance, and if the capital has the risk appetite for the sector. With that being said, let's also take a look at the technicals of UPST Upstart. The trading volume of Upstart has recently been 8.5 million shares, compared to an average volume of 10 million shares. Over the previous 52-week period, its price fluctuated between $72.50 and $401.49. The market cap of Upstart is currently at $6.3 billion, compared to an enterprise value of $15 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so on a relative basis, it's less reactive than the market cap and often more lenient as well. One key element to note about the enterprise value is that for many growth-type companies, one of the most significant assets they own may be called goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it may have a better management, a stronger brand recognition, or a bigger online following. It is what makes a company unique compared to the competitors. In other words, it's not a tangible asset that companies may use. It's, however, very often the reason why some companies may be perceived to be trading at a discount, as the market cap is lower than the enterprise value, because the enterprise value may be less reactive to the market cap in very volatile situations. If the company goes to liquidation, the goodwill would be gone, and we would be left sharing whatever that is left on the balance sheet that hasn't depreciated yet. When we compare the current price to the historical price fluctuations, the stock is 10% higher than the 1-month low, 10% higher than the 12-week low, and 10% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment on where the stock price is likely going to go next, the implied volatility is 152% versus a historical volatility of 102%. The put-call volume ratio is currently 0.62. It is normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 18,000 contracts a day versus the 30-day average of 37,000. In terms of open interest, the most recent volume of open interest has been 367,000 contracts versus the 30-day average of 293,000 contracts. In terms of the shareholder structure, institutional shareholders own 56% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Vulcan Value Partners. It's relevant to understand the shareholder composition of a company because this helps us to determine if you should be holding the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions, as there are many great companies mostly held by retail investors as well. But that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are a significant short interest in the total volume, this can be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is about 19% of the total float, and 53% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of it coming out of the dark pools, it may suggest that there are institutional positions taken to short the stock, and there would be potential for a short squeeze. Now, based on my analysis, I believe that we should enter in Upstart now and to keep a position in anticipation of the catalysts that will push the price upward. I believe that the current stock performance is in great part due to the sector-wide sentiment and not specifically related to the fundamentals of the company in particular. I would recommend between 1 to 3% of your portfolio to be put in Upstart now. I would also recommend to split your allocation in batches of 35 to 40% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.